So we are live in Johannesburg, where just about 55 kilometers away, the governor of the Central Bank of South Africa, Lesetja Kganyago, has just announced what had been widely expected by the markets. And I think to say widely is, to an extent, an understatement. 29 of 30 economists surveyed by Reuters expecting a hold. And 1 out of 26 economists surveyed by Bloomberg expecting a hold. And so a hold it was in the end. But are there any messages that we took out of that display by the governor that will help us to understand where interest rates are going in the future? Joining me for that discussion is Annabel Bishop. She's Chief Economist at Investec. Isaiah Mhlanga, Chief Economist and Head of Research at Rand Merchant Bank, and Gulam Balim, Chief Economist at Standard Bank Group. Lady and gentlemen, thank you for your time. You listened as intently, I think, as all of us did to the governor, outlining the case for holding interest rate. Gulam, I'll start with you. From your perspective, I would imagine this was in line with what you expected, but I want to know if there were any surprises in terms of the key numbers that the governor mentioned going forward that would make you change where you think rates are going from here on.
Godfrey, hi. Largely in line with expectations, and no, I don't think there was anything that emerged that would be jarring. Broadly, we anticipated a hawkish narrative, which was delivered. So the idea that the SARB governor would assume a cautious posture in the face of imminent increases in the year-on-year rate of inflation over the next month, if not two, was entirely consistent. But having said that, there was also acknowledgement that real interest rates in South Africa are in restrictive territory. In other words, they are serving to curb the economy and to temper any demand-driven inflation, but at the same time have potent signaling value. So in that respect, I would say for the moment, and despite the Rand's general weakness, we don't anticipate further interest rate hikes. We think there will be a steady pause into, say, the first, maybe even the second quarter of next year before the possibility of some relief, barring any material shock.
Yeah, and we shall come and talk about what we can expect in the coming year and when that will be. Isaiah, I want your top line takeaways. I saw the decision by the Central Bank of the United Kingdom to leave rates on hold being characterized as a hawkish hold. Gulam has just mentioned some hawkishness in the governor's statement there. Would that be one that you use to describe the decision that we just got here?
Absolutely. I think it is a hawkish hold. The governor emphasized towards the end of his statement to say risks are tilted to the upside. And he mentioned a couple of them: the potential for the currency to weaken, energy prices, food price inflation. But he could also add the risk premium potentially increasing because of fiscal concerns, which is something that we have heard from National Treasury over the past couple of weeks. So quite consistent to what Gulam has mentioned. But I think the one aspect that we also see from this, MPC statement and its forecast is economic growth has been revised upwards by quite a decent margin from 0.4% to 0.7%. I think we have seen this also in our own forecast. We had revised up historically because we have seen upside surprises in both the first quarter and the second quarter. So the economy seems to be quite resilient, even in the face of this more intensive load shedding. I think that's a theme that is quite consistent. It's just not yet showing up in the fiscal numbers.
Yeah, I'm going to be mischievous and say he doubled the SARB's growth outlook. Doubling from what? Yeah, key question. Annabel, your thoughts and your key takeaways in terms of that decision? Is that also the phrase that you'd be using, a hawkish hold?
Yes, hi Godfrey. So think, just having a look at last night's Federal Open Market Committee and what the United States felt about their interest rate outlook and South Africa's as well, I think we see in both areas that there's certainly room for the interest rate hike cycles to have ended, which is obviously good news. There are obviously still concerns amongst both countries. And just as in South Africa, where our GDP growth forecast was revised up quite significantly, just from a numbers point of view, as you said, a near doubling, but obviously still a very low growth. The United States actually, interestingly, also saw their economic growth forecast revised up and their inflation forecast revised down. And I think this is perhaps a little surprise that's coming around the world. It's a positive because it means that we can end our interest rate hike cycles quicker than some have feared. Others, of course, ourselves included, have expected, the South African interest rate hike cycle to have already ended. But as we look forward into next year, I think that the inflation outlooks are seen to be a little bit more subdued. And I think that's where the real positive comes in for monetary policy for South Africans and, of course, around the world. The concern, obviously, is that the interest rate hike cycles have been quite severe, not just in South Africa, but in other countries, negatively affecting consumers. And of course, there are lagged effects that come through in terms of higher interest rates, starting at about 2 to 3 quarters and ending in about a year to 18 months. And that means that the higher interest rates and interest rate hikes are still going to yet to have their full effect come through, which will still be suppressive on inflation. So from that perspective, I think that the central banks may feel they have done what they needed to do, but they probably will continue to warn about the possibility of further interest rate hikes, and that's obviously to try and contain inflation expectations, which are absolutely key. SARB mentioned that in its report, saying the BER inflation expectations, were a bit high, and they'd like to see them lower and get more towards the midpoint.
Yeah. And I want to pick up on that risk to the inflation outlook, because the governor did say that risks to the inflation outlook remain to the upside. And in particular, I wanted us to explore the 3 key risks that I picked up. You guys would probably have picked up more that he mentioned, and ask the question, is there a risk here that higher oil prices, a weaker exchange rate, and the dangers that we are seeing around government finances could potentially mean that we could get another hike and perhaps more into 2024? How high is that risk, Annabelle? I'll start with you.
Okay, thanks. So I think the risk is actually fairly low at the moment, because I don't think we can prejudge where oil prices are going. And by that, I really mean that they're already quite high. They're already above $90 a barrel. Here we're talking about Brent crude. They might move to, closer to or just at $100 a barrel. But that on its own is not going to unanchor, the inflation trajectory. In fact, inflation is likely to rise to about 5% and stay around the 5% mark up until February next year, due to base effects that we had from a year ago. You recall, Godfrey, that a year ago we obviously saw inflation peak at 7.8% in July, and then inflation fell off thereafter. And that downward trend in inflation obviously has an impact on inflation rates this year and pushes them up a bit. So that's certainly a bit of a risk. The oil price you mentioned, for oil prices to get very substantially high, you'll need to really have very strong demand coming through globally, and especially from China, and that doesn't look likely. There's been a bit of an improvement in China, but no one's expecting to see a really strong boom taking place this year or next year. Of course, there are risks that particularly from the El Nino, which perhaps you haven't mentioned, and high inflation next year from food price inflation. That does remain a worry, and I think something we'll have to take quite seriously, because in the past food prices have had a very large effect on inflation. I do think, however, though, that the deterioration of government finances is weighing quite heavy on the Reserve Bank concerns. We see it coming through in much of the statement, and of course that obviously is something which is going to be addressed on the 1st of November when we see the MTBPS, the mini budget, hopefully by a cutback in expenditure, although of course the worries are, still that government might not do it. National Treasury seems quite keen from all the communications we've seen there. Perhaps less buy-in from the president, but certainly some of the departments as well. And I suppose that's as normal. I'll have to discuss it. And the exchange rate, of course, remains a wild card. But given the last night's FOMC meeting commentary from the United States, it was quite clear that they are certainly providing a more balanced tone, not as hawkish as they had before, and that would lead into next year for the possibility of cuts in the United States interest rates, which would be supportive of the rand and, of course, of a further moderation in inflation. We expect inflation could be around 4.6% next year for CPI inflation. But again, the big risk to this, we really feel, is probably the most coming from food prices. You know, in case we really do go into a bad El Nino environment, perhaps also negatively affected by climate change. These are the worries, Godfrey.
Sure.